Right now, every headline feels like it could change the market in seconds. One tweet, one announcement, one unexpected move and everything flips. Investors are confused, portfolios are shaking, and most people are stuck asking the same question. What happens next? But here's the reality nobody is talking about. It's not about predicting when this war will end, because honestly, nobody can do that. The real opportunity lies in understanding what happens after it ends, because while the crowd is focused on fear, uncertainty, and short-term losses, smart investors are quietly watching something very different. They're watching which stocks are holding strong right now, in the middle of all this chaos. And that's important, because historically, the stocks that fall the least during panic are usually the ones that rise the fastest when things turn around. So instead of reacting to headlines like everyone else, the real question you should be asking is this: which companies are already positioning themselves to win when the dust settles? In this video, we are going to break down 3 specific stocks that could be among the first to surge once this conflict finally comes to an end. And what makes these picks different is that they are not random guesses or hype-driven plays. They are based on a clear strategy that focuses on resilience, long-term strength, and how markets actually behave during recovery phases. Because here's something most people forget. The market doesn't wait for good news. By the time everything feels safe again, the biggest moves have already happened. That's why understanding the strategy behind these picks is just as important as the stocks themselves. So before we dive into the 3 names, you need to understand how experienced investors think during times like this, when volatility is high, emotions are even higher, and the difference between panic and patience can determine your entire financial future. When markets start moving like this fast, unpredictable, and driven by headlines, it's easy to feel like something is fundamentally broken. Every day, there's new information, new fear, new uncertainty, and it creates this illusion that this time is different. But if you zoom out for a second, you notice something important. Volatility like this has happened over and over again throughout history. The difference isn't the situation, it's how investors react to it. This is where strategy matters most, because while short-term traders are trying to guess the next move, long-term investors are focused on something much more powerful: consistency. Especially when it comes to dividend-paying companies. These are businesses that have survived recessions, crashes, and global crises before. They continue generating cash, continue rewarding shareholders, and continue growing over time. So instead of panicking during volatility, experienced investors actually lean into it. They understand that temporary price drops don't change long-term value. And here's where it gets interesting. Despite all the negative headlines, some stocks are already starting to stabilize, even move higher. That tells you something. The market, despite all the fear, may not be expecting the worst-case scenario. And if that's true, then the biggest opportunity might not be where everyone is looking. Now let's address the elephant in the room: fear. Because if you've been watching your portfolio lately, especially if you're investing for retirement, chances are it hasn't been a comfortable experience. Seeing your investments drop, sometimes sharply, can trigger a very natural reaction: panic. But this is exactly the moment where perspective becomes your most valuable asset. The first thing to understand is simple: if you have money in the market that you need in the next 2 to 3 years, it probably shouldn't be there. Not because the market will definitely go lower, but because short-term volatility is unpredictable. That kind of money needs stability, not risk. But for everything else, the long-term capital, you have to remember how markets actually behave. Bear markets are not unusual. In fact, they're a normal part of the cycle, and most of them don't last nearly as long as people fear. Historically, many downturns recover faster than expected. Think about past crises, the financial crash, the dot-com bubble. They felt devastating in the moment, but they didn't last forever. And more importantly, every single bear market in history has been followed by a bull market, no more exceptions. So the question isn't whether recovery will happen, it's whether you'll be positioned for it when it does. Let's move into the first opportunity. And this one might surprise you, because it comes from a sector that's been under serious pressure. Financials, banks, credit companies, and financial institutions have taken a hit during this period of uncertainty. But here's the key insight: you don't want to look for the strongest sector right now. You want to look for the strongest companies inside the weakest sectors. because those are the ones showing resilience when everything around them is struggling. And that's exactly what we're seeing here. This particular stock hasn't collapsed the way many of its peers have. It's holding up better, staying more stable, and quietly outperforming others in the same space. That's not random. That's a signal. It suggests that when the sector eventually recovers, and it likely will, this company could be one of the leaders driving that move. And there's a deeper reason behind that strength. This isn't just another bank competing locally. It has a global footprint, operating in dozens of countries, providing essential services that businesses rely on worldwide. That kind of reach creates a level of stability that many competitors simply don't have. So while the sector looks weak on the surface, underneath it, leadership is already forming. So why has the financial sector been hit so hard in the first place? It all comes down to a chain reaction that starts with one key factor: oil. When oil prices spike, it creates pressure across the entire global economy. Higher energy costs mean higher expenses for businesses, reduced spending power for consumers, and slower overall growth. And when the economy slows down, financial institutions feel it almost immediately. Fewer people are borrowing money. Companies delay expansion. Investment banking activity slows. IPOs become less attractive. Everything that fuels growth in the financial sector starts to shrink. And the market, being forward-looking, doesn't wait for this to fully happen. It starts pricing it in early. That's why you see these stocks drop quickly, sometimes even before the real impact shows up in earnings. But here's where things get interesting. If the cause of the problem begins to fade, if oil stabilizes, if uncertainty decreases, if confidence starts returning, then that entire chain reaction can reverse just as quickly. And when that happens, financial stocks don't just recover. They often move fast, which raises an important question. What happens if the market is already preparing for that shift? Now the second stock comes from a completely different space: telecom. And at first glance, this might seem like a safe, boring sector. After all, people aren't going to stop using their phones or internet services, right? But even here, we've seen pressure. And that's what makes this opportunity interesting. Because, despite the sector struggling, this company has been quietly holding its ground. Not only that, it offers something incredibly valuable in uncertain times: strong, consistent income, a high dividend yield that continues to grow year after year. That's not something you find easily, especially in volatile markets. But there's more to the story. This isn't just about stabilities, about positioning for recovery. When economic conditions improve, when consumer confidence returns, spending patterns change. People move back toward premium services, higher quality products, and better experiences. And this company sits right at the top of that premium category. On top of that, there are potential tailwinds that most people aren't even considering, like increased infrastructure spending or expansion into underserved areas. These are long-term catalysts that could drive growth beyond just a simple recovery. So while it may look like a defensive play on the surface, there's actually a strong case for upside here. But if telecom is so essential, why has the sector been under pressure at all? The answer comes down to behavior, specifically consumer behavior during uncertainty. When people feel unsure about the future, they start making small adjustments to protect themselves financially. They cut back where they can. They look for cheaper alternatives. They delay upgrades. And even though a phone plan might seem like a necessity, the type of plan they choose can change. Instead of premium services, they might switch to more basic options. And that's where companies at the higher end of the pricing spectrum feel the impact first. It's not that customers disappear, it's that they become more cautious. The market understands this, and it reacts accordingly, pushing these stocks lower in anticipation of slower growth. But here's the flip side, and this is where the opportunity lies. When confidence returns, those same consumers often reverse those decisions. They upgrade again. They spend more freely, and companies that were temporarily pressured can see a sharp rebound. So what looks like weakness today might actually be setting up strength for tomorrow. And the companies that maintain stability during the downturn are usually the ones that benefit the most on the way back up. Now here's something that might go against everything you've heard before. Analysts' price targets don't matter nearly as much as people think. In fact, they can often be misleading. Because most analysts aren't trying to predict the future, they're reacting to the present. They adjust their expectations based on what has already happened, not what's about to happen. And that creates a lag. By the time they upgrade a stock, the biggest part of the move has often already occurred. This leads to a kind of herd mentality, where everyone ends up saying the same thing at the same time. And while that might feel safe, it doesn't create opportunity. Real opportunity comes from thinking differently, from identifying value before it becomes obvious. That doesn't mean ignoring data or analysis altogether, but it does mean understanding its limitations. Sometimes, the best setups are the ones that the majority is overlooking or underestimating. And when sentiment is low, expectations are low, and attention is elsewhere, that's when the potential for upside is the highest. So instead of following consensus, the smarter approach is to ask, what is the market missing right now? Because the answer to that question is often where the biggest gains are hiding. The third and final stock comes from a sector that's been hit harder than almost any other airlines. And for obvious reasons. Rising fuel costs, global uncertainty, and shifting demand have created a challenging environment. But once again, the focus isn't on the sector, it's on the standout within it. This company has a unique advantage that sets it apart in a way most people don't even realize. While other airlines are struggling with rising fuel costs, this one has built-in protection. It controls a key part of its own supply chain, allowing it to manage costs more effectively than competitors. And that changes everything. Because in an industry where margins are tight, even a small advantage can make a huge difference. But that's not the only reason it stands out. Despite all the challenges, demand for travel hasn't disappeared. Flights are still full. People are still moving. And that underlying demand creates a strong foundation for recovery. Add to that solid earnings growth expectations and relatively low valuation, and you start to see a compelling picture. This isn't just a recovery play, it's a company that could outperform significantly if conditions improve. And if the sector turns around, this could be one of the biggest winners. When you step back and look at all three of these opportunities together, a clear pattern starts to emerge. These aren't random picks from strong sectors. In fact, it's the opposite. Each one comes from a sector that's currently under pressure. But within those sectors, these companies are showing relative strength. And that's the key idea. Leadership during weakness often turns into leadership during recovery. Because when conditions improve, money doesn't flow evenly across the market. It flows first into the names that have already proven their resilience. And that's exactly what we're seeing here. So instead of chasing hype or reacting to headlines, the smarter approach is to focus on positioning. To ask yourself not just what looks good today, but what could look even better tomorrow. Because by the time the news turns positive, the opportunity won't be obvious anymore. It never is. The biggest gains happen when uncertainty fades, not when it disappears completely. So now the question is simple. Which of these three would you be watching the closest? And more importantly, are you preparing for what comes next or waiting until it's already too late? And here's the truth most investors realize too late. The biggest opportunities in the market never come when things feel safe. They come when uncertainty is still in the air, when headlines are still negative, and when the majority is too distracted by fear to see what's forming right in front of them. Because by the time the war ends, by the time the economy feels stable again, and by the time the news finally turns positive, the market will have already moved. The smart money won't wait for confirmation, they're already positioning now. And that's exactly what separates those who build real wealth from those who are always chasing it. Think about it, every cycle follows the same pattern. Panic, hesitation, then recovery. But most people only act during that last phase when the easy gains are already gone. Right now, we're somewhere between fear and transition. And that window, that's where the real opportunity lives. The question is, will you recognize it? Or will you wait until it's obvious? So don't just watch these three stocks, understand why they were chosen. Because once you understand the pattern, you won't just rely on tips. You'll start spotting opportunities before the crowd does. And that's when everything changes. If you got value from this, make sure you stay ahead of the next move. Because what happens next in the market could be even bigger.